Okay, so the crypto market has just taken a nosedive, and suddenly everyone is asking the same question. You've seen it, right? The charts are bleeding red, the mood is, well, it's tense. The whole market is just holding its breath.
Is this it? Is this the start of another long crypto winter? Or is this a classic bear trap, designed to scare everyone out right before the next huge rally? The thing is, the experts, they're totally split. So let's break it down.
All right, first up, before we get into any theories, let's just look at the numbers, the cold, hard facts that are making everybody so nervous right now.
That's a 6.6% drop in the entire crypto market cap, and we're talking in just 1 week. That one plunge basically erased almost all of the gains we saw back in September, just gone. And look, this isn't some small dip. It's hitting the big names, and it's hitting them hard. Solana took the biggest hit of the top 10, dropping almost 20%. Meanwhile, you've got Bitcoin and Ethereum falling below those big psychological numbers everyone watches. Not great.
So with drops like that, it's really no surprise that a lot of people are thinking the worst. So let's dig into that first scenario, the idea that crypto winter is officially back.
You've probably heard of Peter Schiff. He's a longtime crypto skeptic, and he definitely doesn't hold back. He's not just calling this a winter. No, he's saying prepare for a crypto ice age. Big difference, right? An ice age implies things aren't thawing out anytime soon.
Now, Schiff's view is pretty extreme, for sure. But other analysts are pointing to some genuinely worrying signs too. Get this. Historically, for the last 30 years, major bear markets have often kicked off right as the U.S. Federal Reserve starts cutting interest rates. And guess what the Fed just started doing? Yep, cutting rates.
Okay, to really get the bear argument, there's this one metric you have to know about. It's called the short-term holder cost basis. It sounds complicated, but it's not. It's basically just the average price that all the recent buyers paid for their Bitcoin. You can think of it like a battle line, the dividing line between a bull and a bear market.
And here's the kicker. Right now, Bitcoin is trading below that line. Now, in a healthy bull market, you might see the price dip below it for a little bit, but it would bounce right back up. The worry is, what if it doesn't? If it stays below this level and keeps getting rejected when it tries to climb back over? Well, analysts say that is a textbook classic sign that the bears are in control.
But wait, just when things look really bleak, there's a totally different story playing out. So let's flip the coin and look at scenario 2, the argument that this is all just one big bear trap.
So what's a bear trap? It's a classic fake out. It looks like a crash, it smells like a crash, it makes everyone panic and sell their holdings. But it's all a trap, designed to shake out the nervous sellers right before the price turns around and rockets higher.
The people who believe this theory, they're arguing that we are nowhere near the end of this big bull cycle. They say we're still kind of in the middle of it, and there's still one last huge euphoria phase left to go. The part that sends prices to insane new all-time highs. And their biggest piece of evidence is actually what we're not seeing. All those typical warning signs that flash red when a market is about to top out? Well, they're just not there. The fear and greed index isn't screaming extreme greed. Other metrics that measure how euphoric traders are, they're surprisingly calm. The argument from the bulls is simple. You can't have a real market top without the crazy widespread mania, and we just don't have that yet.
And it gets better for the bulls. There are 2 really positive things happening under the surface. First, on-chain data shows that long-term investors, the diamond hands, are selling less. And at the same time, the big institutions are still buying, basically soaking up whatever supply hits the market.
Okay, so we've got 2 very strong, totally opposite stories here, and both have data to back them up. So let's put them head to head. Let's look at the signals you need to be watching.
This is really the battleground right here. On one side, you have the bears, and they are laser-focused on that STH cost basis and what the Fed has done in the past. But on the other side, you've got the bulls, and they're pointing at the fact that we're missing all the classic top signals, and that big institutional money is still flowing in.
So, what's the verdict? The truth is, the market is sitting on a knife's edge. It could honestly go either way.
The big takeaway here is that this isn't just random price action. There are real, logical arguments and very specific things to watch that are driving both the fear and the optimism in the market. It's a genuine tug of war.
So the real question isn't about trying to predict the future with a crystal ball. It's about which of these stories you find more convincing. Are the historical warnings and the broken technicals of the bear case going to win out? Or is that quiet, steady demand from the big players the new wild card that makes this time different? The market is about to tell us which story is the right one.